US equity markets have proven themselves to be highly resilient despite the curveballs being thrown at them of late. And that pushes the onus onto people to find another reason why equity markets are due a major pullback. And the reason for it is the success of the stock market, saying that the valuations now being seen are not justified and the multiples have got too high. Therefore, we're due a pullback. Well, let's get into the topic of whether US equities are overvalued, whether this means we should move into different sectors or different geographical regions as a result, or maybe the US is just the place to be. First of all, let's look at why the S&P 500 gains ground. Why is it in an upward trajectory? Well, the reason is that it generally tracks the increase in terms of earnings per share for the underlying companies. Therefore, as long as we continue to see earnings grow, profitability grow, then the value of the index grows. And we can see that here with the chart that shows the S&P 500 overlaid against the 12-month forward earnings per share. So earnings per share is rising, but also the expectation of next year's earnings per share is also rising. As long as the expectation of future growth continues to rise, then everything's fine. But when you see question marks around valuations because of the slowing of that growth rate, that's where you see the possibility of a pullback over the near term, a normalization, a consolidation phase, that kind of thing. And so at the moment, with the fact that we've got stretched valuations and multiples, people, of course, will raise questions on whether we're due one of those pullbacks, due one of those consolidation phases to take a breather because of the strong run up that we've seen in terms of equity markets. Now, notably, not all sectors are made equal and not all markets are made equal. You can see that here with the different regions and different markets and different sectors attributing to different price to earnings ratios. So it stands to reason that the fastest growing companies have a higher ratio attached to them than the slowest growing companies. And so if you look at, say, the top performing indices, you'd be looking at the likes of the NASDAQ over in the US, which is heavily geared towards the likes of the big tech names. Then we've got the S&P 500, which has a heavy weighting of those big tech names. And then if you look at the underperformance in terms of US markets, the Dow, which doesn't have as many of the Mag 7 names, and then the Russell 2000, it doesn't have any. That's the small caps within the US. In terms of Europe, you do have a lower price to earnings ratio. So generally, it will be in the high teens. And that might attract people to invest in European stocks instead of US stocks because they think, well, it's at a price to earnings ratio which shows it to be undervalued. That's not necessarily the case. And you can see that in the middle section of this table, because the likes of the UK has sort of 18 to 19 price to earnings ratio, but on a 5-year, 10-year, and 20-year average, it's expensive. And that means that there is a general or average price to earnings ratio that these markets generally have. Arguably, you would have to say, are we in a different position now than historically has been the case? You could argue that is the case for the US in particular because of the valuations attached to the possibility of this AI boom, where the US seems to have the possibility of massive growth and to essentially own the AI boom. There are other markets that you could see significant benefits for it. The Chinese, of course, have the possibility of providing a secondary major hub for AI. But that's why you're seeing this increase in terms of multiples over in the US, but it's also coming in line with a narrative around a new type of growth that could prop up growth levels for an extended period of time to levels that we haven't seen previously, and therefore you attach higher multiples. When we don't see those multiples hold up, or when we don't see those growth levels hold up, that's when you start to see the multiples come into question. On the right, you can see here the IT sector, the top performing in terms of the price to earnings ratio. So people attach very high ratios or multiples for the big, high, fast growing companies. And that, of course, is wound up in the Mag 7 names in particular, but there are other tech names over in the US as well attached to that. So just because a region or a market has a lower price to earnings ratio does not mean that it is cheaper than, say, the US markets, because you have to look from historical perspectives, and you have to look at the underlying companies in question. If a market is just full of old school companies, let's say an airline, how is an airline going to double over a short period in time, right? We don't necessarily have the same ability to expand. They could potentially try to fill their planes more. They maybe try to get better margins. They could move into different regions. So they do have the possibilities to expand, but there's limits to that. Whereas, of course, some of these big tech names in the US, they can literally build out entirely new revenue streams. And with AI, you have exactly that. So you have the possibility of brand new revenue streams to be put on top of the revenue streams they already have. And that's why people are dreaming big when it comes to the growth names in the US. What is justified and what is not justified remains to be seen. And over time, this initial phase where people are spending a lot, or where businesses are spending a lot and not necessarily getting the huge sort of payback when it comes to the end user, that phase at some point comes to an end. And we need to see the payback not only coming from other tech companies that are building out the technology, but instead see it coming from the end user. If we don't see that for certain companies, that's when the multiples really come into question. And that's when it looks overvalued. But until that happens, and until we see these companies sort of slow down in terms of their growth rates in a meaningful manner, you might see them continue to perform well. In terms of the breakdown here for different multiples attached to different segments of the market, you can see the Mag 7 well over and above those within the large cap, which are next up in line. Then we've got the mid cap, then the small cap. So generally the most profitable companies, the fastest growing companies and profitable companies will be at the highest multiples. Then you see at the bottom of the pack the likes of the small caps, many of which will not be profitable at all. And so you, of course, you attach lower multiples to it as a result. Now, next up, we've got the relationship between the pace of growth in terms of earnings per share on the likes of the Mag 7 names, and then the pace of growth for the rest of the S&P 500. And so this really highlights the fact that this year was expected to see a decline in terms of the growth rate for Mag 7 names earnings, and then a major pickup in terms of the rest of the market. Now, what's notable is that pickup for the rest of the market has been pushed into 2026. We haven't necessarily seen that a significant uptick in terms of earnings per share growth, but you've seen that slowdown coming into play for the Mag 7 names. Notably, despite that slowdown, the multiples haven't necessarily contracted in a meaningful manner, perhaps part of the fact that people knew that it was coming and therefore haven't necessarily reacted to it in a meaningful manner. But if we do see that slowdown in terms of earnings growth for the big tech names sort of happen at a quicker pace, then you would more likely come into a position where you see the multiples attached to the big tech names coming into question. So keep an eye out for this. Do we see that multiple pick up elsewhere within the market as you see the growth rates start to pick up elsewhere and you see the normalization of the big tech names growth coming into question? If you look here in terms of the long-term trend, this is the relationship between the ETF of the growth stocks under Vanguard and the value stocks. And this is where the sort of growth versus value argument comes into play. And I always say, look, over the long term, growth wins out. You do have periods where value names outperform, but generally that is a counter trend move. And then the growth names come into play once again. This is a monthly chart, so each candle represents a month, and you can see the growth names, which encompasses all of the big tech names, really continuing to outperform. You will see periods where those value names come into the forefront. It's not the trend over the long term, because growth names with high rates of return, high profitability, will often be the ones that swallow up all of the capital. And whilst you will see periods where those valuations come into question and you see a pullback as a result and a potential normalization of the relationship, that generally will just lead to a period of maybe a retracement, consolidation, and then strength, because ultimately those growth names will continue to grow at a strong pace. The big tech names, yes, even if we do see a normalization in terms of the pace of their earnings growth, if we see a normalization, yes, but then they'll still have strong earnings growth going forward. So it's a moderation and then a pickup once again. And that's why over the long term, growth names continue to outperform value names. If you're trying to find value names as the sort of underperformers and trying to pick bottoms for stocks that are heavily beat up, generally, historically, you would have done better finding stocks that already have gained a lot of ground and continue to gain ground because they are highly profitable, fast-growing companies, despite the fact that they have high multiples. I hope that's been useful, but just as a sort of wrap up, we can see over the long term, you can see here that the outlook in terms of what performs best and worst on a year-by-year basis, you can see here large caps, often the best performing asset on the year. You can see here 25%, 26% over the past 2 years, 28% in 2021, 31% in 2019, sorry. And then you're looking at sort of second place, third place throughout the 2013, 2014, 2015, 2016, 2017. So if you're looking from a historical perspective, the outperformers are the large cap names. So yes, they will have the higher multiples. Yes, they will raise question marks over whether those multiples are justified. But then the next year, they then gain another 20%, and you wish you hadn't thought that they were overvalued at the time. So certainly, they will often suffer at times when markets are rolling over because they are generally the most heavily weighted and there's so much capital in them. So money gets sucked out quite quickly when the market as a whole is rolling over. But from a historical standing, yes, the multiples are high, but they're often justified. And I wouldn't necessarily want to call the absolute top of this AI trade because we might just be in the infancy of it.